Do you ever wonder if it's a good time to buy a stock? Are you ever curious, should I sell my stock now or wait for the price to go higher? I'm going to show you how to value a company using a discounted cash flow model, and then we're going to look at their financial ratios at the end. Watch the whole video because there's going to be a lot of pop-ups with charts, graphs, and additional information that you're going to really want to know. So the company we're going to do today is Kimball International, and they started out making these pretty cool pianos. Now they make home furnishings. So let's get their market cap and put that into the model. $410 million. That's the value of the company according to the stock market. And they trade at $11.19. So now we know the shares outstanding because it's the market cap divided by stock price gives us 37 million shares outstanding. And next we're going to get the free cash flow. Free cash flow is a really important number. That's cash flow from operations minus capital expenditures. And this is the money that's left over after running a business. So if you don't have any cash left over, you really don't have a business. Next we need net income, and this is the profit and loss, and this can be found in the income statement. And the last we're going to need is the revenue, which is just the sales. And we're going to take 4 years of that. And you want to make sure the numbers you're inputting are fairly consistent and positive. You need really those two things in order to run a discounted cash flow model. We have that, so let's move on. We need the capital structure. They have no debt, so we just need to figure out the cost of equity. Get the beta, that's the volatility of the stock. The higher the beta, the more volatile the stock is and the more risky it is. The lower the beta, the less volatile and the less risky. So the cost of equity is 10.23%, and we use the capital asset pricing model to figure that out. So that's the weighted average cost of capital, and that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows, then we did a terminal value, which is all years past year 4. We discounted those numbers back to today's dollar amounts, and we get a value of the company of $407 million. We divide that by 37 million shares, and the intrinsic stock price is $11.12, which is just 7 cents less than what they're currently trading at. That is pretty amazing how close it is. Let's look at Simply Wall Street just to see what they get. Their fair value is $7, so their model is more aggressive. Historically, their stock price has been trading at a premium, well over $11 for a good 2-3 years. It's come back down to reality ever since coronavirus hit, so it seems like it's been trading around intrinsic value. Maybe a year ago it would have been a good stock to short, but now it looks like it's trading where it should be. Let's look at the financial ratios of the company. First, we need some more information from the balance sheet. Let's get their current assets. These are assets that can be liquidated into cash within 1 year, and they generally include cash, accounts receivable, and inventory. And they have $230 million of current assets. Let's get their current liabilities. These are payables and debt, which are due within 12 months, and that's $133 million. And the equity, that's the value of the company according to the balance sheet. It's total assets minus total liabilities. That's $216 million. Let's also get their EBT, that's their earnings before taxes. And that's how much money they generate from their regular business. That's $50 million. So now we have the ratios. Let's look at that PE. They have a good PE. It's under 15, which is what I like. The average market PE is 26, and the median PE of the market is 16. They also have a good price to sales ratio. That's 0.5. The average is 4.3, and the median is 1.8. That's price of stock over sales per share. Their price to book is also good. I like to see under 3 or so. They have 1.9. The average is 3.5 and the median is 2.2. Good current ratio between 1 and 2. That's what I like. They have 1.7. So their current assets can cover their current liabilities. They have a pretty good ROE. I like to see 20%. They're close to 20%. The median ROE for the market is 15%. And they don't have any interest, so they have nothing to cover and no debt. So it looks like a pretty lean company. And I think it seems like a good investment if you think the company will grow in the future. Let me know what you think in the comments about this company and about the video. Thanks for watching.